Good morning, everybody. My name is Martin Czech. I'm the Chief Executive at the International Capital Market Association. And it's my great pleasure to welcome you all to today's AMIC virtual event organized by our Asset Management and Investors Council on the lessons that we can draw from the COVID-19 crisis from a fund liquidity perspective. And it's my privilege just to say a few words by way of introduction. As I hope you're aware, our mission at the ICMA is to make the international debt capital markets operate as effectively as possible. We have a very broad membership of around 600 institutions worldwide from over 60 different countries. And these members come from all segments of the capital markets: issuers, investors, intermediaries, market infrastructure providers, central banks, and law firms, for example. And they all unite with us to create and promote standards of best practice and to ensure a balanced and proportionate regulatory environment allowing the capital markets to fulfill their potential in their important function. And we focus specifically on the way the primary markets work, the secondary markets, the repo and collateral markets, as well as sustainable finance. And in each of these, we engage with both buy and sell side members. AMIC, which is composed of large asset managers and asset owners, contributes to each of these working priorities, but also looks after specific buy side topics, such as the one on the agenda today, fund liquidity. Now, fund liquidity has been a focal point for supervisors, asset managers, and investors since the 2007-2008 Great Financial Crisis. And since then, as we know, significant regulatory reforms have been implemented to strengthen the financial ecosystem, and these included a number to address specific financial stability risks which were identified within the asset management industry. For example, some of these reforms were concentrated on liquidity risk management frameworks and the stress testing of open-ended mutual funds, with others addressing money market funds and reporting requirements. So not surprisingly, fund liquidity has been a major AMIC workstream for a number of years. As we know, the resilience of the capital markets was severely tested by the onset of the COVID-19 pandemic in Europe in March and April 2020. We witnessed extreme volatility, liquidity issues, the famous dash for cash, and some market dislocation in a number of market sectors. It was only the coordinated intervention of central banks followed by fiscal measures which kept the markets functioning. And this was true even for some of the most liquid markets, and I'm thinking here of government securities and money market funds. And for the fund managers, it was an exacting test of their liquidity risk assessment frameworks and their ability to meet redemption requests. Whilst we know that the vast majority of mutual funds demonstrated strong resilience and did meet redemption requests throughout, there were some funds that temporarily suspended dealing, largely as a result of valuation concerns in fast-moving and one-sided markets. And although this didn't lead to any systemic issue, there are always lessons to be learned from such a situation. And it's relevant that both the FSB and IOSCO have announced that during 2021, they will be reviewing the operations of money market funds and the CP markets and drawing conclusions, which will no doubt ultimately find their way into policy recommendations. So this is a very timely webinar. It's a very timely panel, and I'm extremely grateful to the panelists for being with us today. The panel will take stock of the strengths and weaknesses revealed by the crisis to help assess how the lessons from this crisis might be reflected in future market practices, how liquidity risk frameworks might be adapted, and to identify any policy learnings. Now, the panel will be moderated by Irene Ray, one of my ICMA colleagues working with the AMIC. So Irene, let me hand over to you to introduce our panelists. And again, I'd like to thank the panelists in advance for their contributions today. It looks like an excellent panel. Thank you very much, all of you, for coming. Over to you, Irene.
Thank you, Martin, and good morning all. Welcome to today's virtual event. I'm Irene Ray. I'm an associate working on the Asset Management Investors Council and I'm delighted to be joined by a highly distinguished panelist, Stefan Kern, Chief Economist and Head of Risk Analysis at the European Securities Markets Authority, Donald Edgar, Managing Director of Risk and Quantitative Analysis at Blackrock, Stéphane Janin, Head of Global Regulatory Development at AXA Investment Managers, and Bob Parker, very own Chairman of AMIC, as well as member of Investment Committee at Quilvest Wealth Management, and member of the Fund Supervisory Board at ARCA's European Infrastructure Fund. Welcome all. We've gathered this panel in order to discuss fund liquidity and lessons learned from the COVID-19 crisis. ESMA has published a very detailed analysis looking at liquidity risks in investment funds, particularly in corporate bonds and real estate asset funds. We'll begin the discussion looking at ESMA's key findings and discussing the panelists' experiences throughout the crisis, followed by the risks to consider in the coming year, and then the recommendations and lessons learned from a policy perspective. We'll then have an opportunity for a short Q&A session where you can submit your questions using the Q&A function below. Many thanks to you all, and let's dive straight into the discussion. Stefan Kern, over to you. Thank you very much for making the time to discuss this extremely timely topic of conversation. We'd love to hear more from you on the background and the key findings of your report.
Irene, thank you very much. Good morning from my side, and let me thank you again for inviting me to join you on this panel. It's a great opportunity for us to share what we have found in the wake of the COVID turmoil on the asset management industry and the liquidity situation, but it's also, as usual, a great opportunity for me, for us at ESMA, to hear what you, the very dear panelists here, but also the members in the audience, think about our findings and any new evidence that we may find interesting in carrying forward our work. So it's a great pleasure to be here, and thank you so much for having me. Now, I would like to share with you a few of our findings in advance, like you have indicated. Let me first of all say that overall in our risk assessment, currently markets are still tense in the sense that we do find, of course, extremely problematic the valuation levels that we have at the moment. So the overall market environment is exuberant, and that in and by itself is not only interesting, but also a source of risk. And in our risk assessment, we clearly indicate that we will have in March going forward our update of the risk landscape, and you will see that pretty intensively covered. Now, against this background, we look back at the COVID experience, and you can see on the slide here, slide 2, that the performance during the COVID turmoil in the fund industry was, of course, very drastic in the sense that funds clearly in their performance reacted to in the initial weeks of the turmoil to the market environment. They dropped quite heftily in that period, and since then luckily have recovered, not fully reflecting the market rebound, but they have recovered, even though the fund volatilities remain slightly elevated in the current environment. Now, in terms of inflows, there was a strong flow contraction in the first quarter, of course, but then followed by an equally remarkable rebound that brought in new inflows in the third, in particular, and fourth quarter, which substantively outweighed the outflows during the turmoil, which is a positive sign, of course. And in terms of resilience, we find that the industry is overall stable with pockets of risk, and we'll get to that in a minute. Our own stress simulations indicate that in excess of 80% of AIFs and UCITS are resilient by the standards that we apply and in the light of the scenarios that we calculate. Overall leverage, which is one of the concerns that we have alongside liquidity and which plays in with that concept, has increased during the turmoil period, which has to do, of course, with the contraction of the net asset value of the funds, especially in hedge funds. And the cash holdings, even though we had a short-lived rise in the cash positions in the second quarter, which is also part of the liquidity management of the funds, have returned to their structural decline, which is also something that we take a look at over and have taken a look at over the past few years, and where we need to be alert. As you indicated, we did a special report in cooperation with the European Systemic Risk Board on especially the corporate debt and the real estate funds, because they, of course, by design, have a particular exposure to liquidity situations. And we therefore did a deep dive. The overall findings that overall the performance and the activities of these funds have been adequate given the circumstances. Only a limited number of those funds that we analyzed actually had to suspend subscriptions or redemptions. And in terms of volumes, this is very low, 0.4% of corporate debt funds, for example. So this is overall an encouraging sign. But of course, we need to be aware that the corona turmoil was a stress period that was comparatively short, and then followed by very significant government and central bank interventions supporting these markets. And we need to be aware that until today, much of the market perceptions, activities, and decisions predicated on the assumption that this government and central bank support will continue. And that is something we need to have a look at. The pockets of weaknesses, like I described it a minute ago, especially around the liquidity risk and the management of the liquidity risk in some funds that we found had potential liquidity problems in the risk management, but in particular around the valuation process in markets where liquidity became sparse. What we also find is that only a few funds actually actively adjusted their liquidity process in light of the corona situation. It might be that, of course, in the meantime, things have changed and a more active approach to these problems has been taken, but this was the initial finding, and of course, this is regrettable. Now, in terms of asset valuations, like I said, this is something that we found very interesting. I'll show you a couple of details. There have been clear concerns over that valuation process, in particular around real estate. And this might have a long-term impact on the portfolios in as far as the valuation problems could continue. And against that background, you have then problems in actually managing the liquidity of the portfolio itself. Now, what we also find around the asset valuation issue that we have a comparatively infrequent adoption of liquidity management tools in the liquidity process, which has to do with the availability, of course. And we'll see that in the following slide, where I give you a few details on the corporate debt fund findings that we have. So we looked at more than 500 funds with over 2 trillion euros in net asset values, 2/3 of which were UCITS. The outflows, of course, were substantive, just under 6% for the UCITS, not so much for the AIFs. And we saw evidence of vertical slicing. So in as far as portfolio compositions were sold, it was across the cash buffers, but also the liquid assets and the less liquid assets across the portfolios. In parallel, and as part of the process, you saw the cash buffers themselves then subsequently increase. And like I said, they've come down since then. On the valuation issues, we find that 15% of the funds that we looked at actually reported difficulties, and there were widespread issues with increased bid-ask spreads and prices missing, for example, and some funds actually had to switch to discounted cash flow models as a result. When it comes to the use of liquidity management tools, 6 of the funds suspended due to valuation issues. Again, that topic coming up. And a pretty large number of the funds, around 1/3 of the funds, actually took recourse to swing pricing. Now, when we look at the overall risk situation of the funds and the preparedness going forward, the liquidity mismatches now accompanied by the problem that more than 90% of the funds we looked at actually offer daily redemption, which of course for portfolios of bond funds can turn out to be problematic in certain situations because assets can be less liquid than that. And actually a large proportion of these funds have no notice periods, especially in the UCITS cohort. What makes the matter a little more complicated is that across the European Union, of course, and we've said that a number of times before in the past years, there is a very heterogeneous landscape of liquidity management tools and abilities of funds to actually react to these situations. And like I said, in the stress simulations, we find the majority of these funds nevertheless to be comparatively resilient. If we then look at the real estate funds, we looked at a much smaller cohort, just under 100 open-ended real estate investment funds. There were no substantial outflows, so the investor base was comparatively stable. Half of the portfolio was exposed to commercial real estate, which might be the more vulnerable part of the portfolio. And again, the valuation issue came up. More than 1/3 of the funds actually reported to be affected by valuation uncertainties, and more than 40% actually saw material distortions in the cash flow. Now, only 2 of the REIFs that we looked at suspended market redemptions in the stress period, and that reflects that this particular subsegment of the market moves on and tries to move on with the current valuation uncertainties without taking recourse to the liquidity management tools, at least to the suspension one. In terms of outlook, Most of the REITs have over average cash buffers, around 10%. But we also need to keep in mind that they are particularly exposed to liquidity mismatches, right? More than 40% of the sample actually use daily redemptions as opposed to a comparatively illiquid asset in the portfolio. An additional problem here is that question of loan covenants. There may be additional liquidity risk if it turns out to be impossible to waive covenants in stress situations, but that is one topic that will be better understood. And then finally, liquidity management tools. Of course, there is a question of availability of these funds, and across the range, only temporary borrowings are actually widely available. And that then brought us to a number of conclusions, as you may know from our report. I understand, an opportunity to talk about those in a minute when we turn to the policy implications. But for the moment, I'm pleased to hand it back to Irene. Thank you very much.
Stefan, thank you so much for this very useful insight into your key findings. Bob, what is your take on ESMA's key findings, and how did investors behave during the crisis?
Let me start with some comments on investor behavior and how that has changed at the end of 2019 and the beginning of 2020. And I think if one starts at sort of December 2019, when evidence of the coronavirus really started to concern investors in Asia and China particularly, and obviously the action taken by the Chinese authorities in January and February of last year resulted in a very sharp contraction in the Chinese economy. So stage one, I think, was investor uncertainty and a move to improve liquidity in portfolios, but primarily in Asian markets. And that was, I think, the main characteristic of investor behavior last January and February. Now, as we moved through the first quarter of last year, and particularly in early February, investors, whether they be institutional or retail, suddenly moved from a situation of complacency at the end of 2019 to, I think it's fair to say, one of alarm as to how the coronavirus was going to impact the global economy, corporate earnings, and capital markets. So as we progressed through February of 2020, increasingly investors were taking more defensive positions, they were raising cash, they were increasing liquidity in their portfolios. And that really came to a head during the first 3 weeks of March. And you saw a classic move in a market crisis. That is to say, you saw a much stronger dollar, really against all currencies. The euro depreciated at one stage well below 1.1, sterling went below 120, and emerging market currencies got hit very hard indeed. We saw a jump in credit spreads in both investment grade corporate bond markets and high yield, and for that matter, emerging debt. And yield spreads, that widening of yield spreads was also characterized by quite a significant decline in market liquidity. And that was very much the case in the corporate bond markets, and it wasn't confined to high yield or distressed debt. I think one other point just to make is that in that market sell-off, that extreme market sell-off that we saw in late February and the first 3 weeks of March, that was also extended to other asset classes. And we shouldn't forget that during this period, we saw a major sell-off in commodity markets, and we saw an extraordinary situation in the energy markets, where at one stage, West Texas Intermediate oil was trading at negative $40 per barrel. And the whole commodity universe saw a major sell-off. One challenge, obviously, during this period was valuing asset classes which became increasingly illiquid. And Stefan has focused with the report from ESMA on the corporate bond market and the real estate market, but there were a number of other areas and funds, such as private equity, such as infrastructure, where asset valuations became very difficult. Now, just commenting on the good work that has been done by ESMA, I think it's absolutely right that the report and the work really focuses on a number of critical areas, whether it be liquidity, risk management, whether it be assets which become difficult to value, and that's not just illiquid assets such as private equity or infrastructure or real estate, it is also corporate bonds and high yield bonds. I think the issue of leverage, which is mentioned in the ESMA report, is also very important indeed, and leverage management. And if one looks at financial and economic crises in the past, one characteristic of those crises has always been difficult to manage leverage and also very high levels of leverage. And I think one observation in February and March of last year is, although inevitably there was some increase in leverage amongst investors, it was very low compared with the very high levels of leverage that we've seen in previous financial crises, and notably in 2008, and also going back to the crisis in 2000. So I think actually leverage management, I would actually argue, was actually handled fairly efficiently. In their report, ESMA obviously have focused on corporate bonds and the real estate market. Just one observation on the real estate market is that clearly the corona crisis has led to areas of the real estate market, and I'm thinking here of retail real estate and also commercial office real estate, where clearly there has been long-term damage. And the fact that we are all sitting on this call and not in our offices, I think highlights the issues in areas of the real estate market. I would also say other areas for focus in the future is the liquidity characteristics of the loan market, and we can talk about that later in this webinar, and also some non-correlated asset classes such as insurance-linked risk and also trade finance. Those are areas, I think, of potential worrying risk in the future, or certainly a risk that needs managing. So I'm going to stop there and pass over to Donald, please.
Thank you for having me here today, everyone. I'm a risk manager at Blackrock. My focus is on fixed income funds, so it's very topical, this agenda for me personally. From my observations of the period, March and April, firstly, what worked? Well, the big success from my perspective is swing pricing. Usually for us, this is a monthly process, setting swings and thresholds. It became a daily, sometimes multiple times per day exercise as market conditions changed, particularly when US markets opened, and if the tone there was negative, that did impact what our investors were doing and what redemptions we saw. It was a very successful swing, was very successful in protecting remaining investors from dilution when others redeemed. Where local rules and maximum swings looked like they might be too constraining, the national regulator showed flexibility. As it turned out, that flexibility was only needed on a handful of occasions, but having that there allowed the funds to operate smoothly without the need for recourse to other liquidity management tools like suspension. So for me, swing was a big success of the period. It was a very stressful period for us personally. We were on video calls constantly during those days, in touch with our trading desks. What else worked well? Pro rata sales of portfolios worked well. So when funds have small flows, the active portfolio manager will use those small flows to help reposition the portfolio to their target goal. And they can, the flows either in or out, let them do that at lower transaction costs. But when funds have large percentage flows, the PMs were disciplined in maintaining the fund's risk profile. And I don't mean they sold a literal pro rata slice of the portfolio. What they sold was a pro rata risk slice. So for a bond fund, that means equal amounts by maturity, by rating, by industry sector, for example. That did work well. That's very much the way index funds are managed in normal markets when they see flows. From a risk management perspective, I was very focused on making sure portfolio managers weren't selling just the most liquid holdings when they had large flows, or they had a sequence of moderate flows. It was very important the risk profiles be maintained. Also, what was working from home? Now, I know individually many of us here have found that relatively easy, but it was obvious in the early part of March that head traders were uncomfortable not having their teams within line of sight. And as they became comfortable and the desktop telecommunications for the trading desk became smoother as the month progressed, delays in trade approval pretty much disappeared. And that was it's something that was very prevalent in derivatives markets, for example, early on. It was difficult to get new interest rate swaps on. And that was partly because all the dealing desks had migrated to home and it was a new environment and there was a risk aversion in taking on risk positions. If we were to have serious second waves again or third waves, I think that kind of issue we won't face in the future. So some of the dislocation from March, I wouldn't expect to be repeated. There are things that didn't work. So for me, primarily, it was the inability as March progressed for dealers to absorb bond flows. So fixed income trade volumes actually increased over the course of March, about 20% higher than usual. But trading costs went up by multiples as the dealers were no longer able to warehouse risk and had to find someone else to take the other side of each trade. And if you demand liquidity, you will be charged for it. That's the bottom line here. The uncertainty in pricing, the difference between quotes in the same bond from different dealers increased markedly as well. It was common to hear traders say that quotes on the screen were not executable. Bond markets rely upon dealers for their smooth operations. In times of market stress, the use of anti-pro-cyclical buffers by the banks might be helpful looking forward. The US SEC reports that funds represented less than 30% of bond trading in the US in March. Despite the lack of a consolidated tape at the moment, we believe that the fund trading is even less than that in Europe. More clarity on what the other 70% of trading, who they are, when they're doing it, would be of great help to all of us in liquidity risk management. Early in the crisis, end-of-day bid-ask spreads really lagged reality. Usually these end-of-day spreads that are published by the index providers are core to our swing pricing process and how to set the swings. In practice, we had to rely heavily on our trading desk to inform us of what market conditions actually were during that period, during the worst 10 days of the period, I would say. Since then, we've developed in-house processes to handle that as a matter of course now and make it a much smoother operation with a system to back it up. But it's something that is worth looking at, I think. Liquidity crunches are rare. What makes it even more important to embed the lessons learned in the organization's DNA to ensure operational readiness. Everyone needs to have practiced what they will be doing in those circumstances, a fire drill. What else didn't work? It's been mentioned, money market funds, the 30% weekly liquidity triggers that many types of funds have clearly looked to have impacted investors' behavior, moving funds from funds with those triggers to funds without those triggers. That clearly needs some more analysis, I think. From our point of view at BlackRock, we would prefer if the meeting that trigger didn't automatically trigger the impact of gates and fees, for example. Pro-cyclical margin increases for central clearers was very prevalent in March. For levered funds, this meant increased initial margin payments, and these were very short notice, and that just added to the demand for cash during the period. So again, anti-pro-cyclical buffers would be one recommendation. Real estate, again, there was a widespread valuation uncertainty, particularly here in the UK. It was compounded by Brexit fears. I would say previous guidance in the UK from the FCA and industry bodies meant that institutional investors were prepared for the suspension of funds. But I think it's less clear that retail investors were prepared for this eventuality. So in summary, broadly, the fund universe did well during the period. However, there are clearly areas for improvement and lessons for all of us to learn from it.
Thanks, Donald. Stefan, what has been your experience during the crisis, and have you made use of available liquidity management tools?
When you ask about my experience, I suppose it's the experience of AXA investment managers.
Yes,
Mine
AXA.
personally was more or less fine. I think generally speaking, it was fine, but I think it was fine also for AXA IM. And just one point before coming back to your question, as a case, Stefan Kern mentioned, outflows during the first quarter of last year, and in fact, we got inflows. So I don't know if AXA Investment Managers was an exception or not, but in our own case, we got inflows over the first quarter of 2020. So it means, and being more precise, in March, we got some limited outflows for fixed income, indeed, but very limited, which were basically, I would say, less than a quarter of the net inflows we had got during the two earlier months and what we got also the months after. And for instance, coming back to the real estate case, which was mentioned by Stefan, for real estate funds, overall, we didn't get any outflow, including in March. So what I think is very interesting is to see that, in fact, sometimes it's very difficult to generalize. And I know it's very difficult not to aggregate figures because regulators and generalist players have to work on aggregate data. The tricky point with the fund industry is that it's a very wide universe universe of players, universe of funds. And typically, I think that in the case of real estate funds, it was mentioned in particular also by Bob, it depends on the underlying types of real assets that you are speaking about, because typically on the residential side or on the logistical side of real assets, typically these type of real estate segments are really still in demand and were still in demand during the whole March period. So I think it's important to keep that in mind. Obviously, we have to work on macro data, but I think we have to be very careful also in digging further in a micro way, depending on fund and depending on players. Overall, I think that ESMA's report findings were very interesting in any case, because it had the merit to be delivered promptly and with a very, I would say, interesting series of reflections. What I've noticed is that overall, if we come back to aggregated data, there was a good resilience, I would say, of the fund industry at worldwide level, including in Europe. So this is really the positive point. What we might think further typically is on two aspects, on the fund side and on the market side. On the fund side, I think that the various experiences which were met by various players and various types of funds show that in any case, what is critical, and it was issued by as analysis of AMIC in various fund liquidity reports, in two fund liquidity reports AMIC issued during the few last years. What is critical is fund designs. We have to make sure that, I'm speaking here about regulated funds, meaning regulated by regulators after and under the responsibility of fund managers. What is critical is really to make sure that at the level of the fund, the overall design is appropriate between the type of assets, specific type of assets, the specific type of fund investor profiles, the specific use of liquidity management tools, a strategy, and also diversification in assets. With this all combined, this is the whole combination of this, which has to be really carefully assessed by fund managers as well as by regulators when they deliver a license for a regulated fund, to make sure that the overall design of each fund is appropriate. This is really a critical point. It's true for real assets, it's true for fixed income in the overall universe of funds. Coming back to liquidity management tools, typically, I think that as a potential series of tools, these tools are really critical. And what is positive in my view is that, at least in the EU, now we have the four main fund domiciles which have liquidity management tools, meaning Germany, France, Ireland, and Luxembourg. Last point, I stressed that beyond fund or apart from fund, the underlying key issue was really on underlying markets. And what I think really regulators have to work on is to improve the functioning of the underlying markets. In our experience, it was striking to be contacted, me or my colleagues, and my market colleagues working at AXA investment managers in particular, to be contacted by regulators or even central banks to get our view of the market. So on the one hand, it's positive to be contacted by regulators or central banks, but on the other hand, it shows that they have themselves some limited view of markets, while they have already a full set of data that they receive through various reports, e.g. IFMD, e.g. MIFID reports, e.g. EMIR reports, and so on. So my ultimate point, and to conclude, is on the following. I think definitely it's critical for regulators to make a better use of the data that they already received through various regulatory reports, to get, in particular, use of artificial intelligence to make a better conciliation between all the data they gather of various kinds, and ultimately, and it's not neutral, to facilitate the exchange of information among regulators themselves, from national one to the central level, but also between central banks and securities regulator. This is the ultimate key point, because typically I think that there was some delay and not a smooth functioning in the exchange of knowledge and data between central banks and security regulators. I think it's a critical point to work on.
Thank you, Stefan. Stefan, what are the key risks to consider in the coming year? But before you address the risk, would you like to respond to any of the observations shared by the other panelists?
I agree with many things that have been said, and it's really insightful to hear what Bob, Donald, and Stefan had to say about their impressions, many of which we also saw reflected from our very specific perspective of being a regulator at European Union level, which of course is a very bird's eye view of things. And let me come back in particular to that last point that Stefan made. I would agree that, and we are constantly improving our use of data, no doubt about this one. And we already have quite a sophisticated view of what's going on. But I think it's also a good part of our culture and our communication culture that we want to hear the assessment. I mean, the data is one thing, but how you interpret them is a different thing. To hear the views of market participants. So when I just want to clarify that when we go back to you guys and in the markets and ask you for your views and interpretations of what is going on in the market, it is to enrich our perspective, because we can't know it all, and certainly not everything is in the data. And of course, in the background, we intensively have a dialogue amongst us regulators and also with the central banks. But we take an interest of what market participants do, how they perceive the current situation, and what they believe would be the best course of action. Please keep in mind also that many of the data sources that we have are on a daily, weekly, even quarterly basis, where the decisions and the actions and the developments that we looked at, especially in crisis situations, often happen on an hourly basis or an intraday basis. So talking to market participants is just essential. And I can predict to you, no matter how many data we have, we will always talk to you guys, right, and give you a call. This is not a threat, by the way. But in any case, I mean, I definitely support that going forward, all of us need to get much more capable of working with these data, especially given the technological development, and we are right on it. Now, on the other points that you raised, I also would like to underline and share one point that Stefan made, namely that the experiences were very different, right? I mean, real estate, like I said, there were very few outflows across the industry, so that was not specific to any particular fund. But on for example, bond funds and also some equity funds, we saw outflows. It just, that's what it is, and that's what is in the statistics, and we need to be aware of that. And you know, no matter how we twist and turn it, outflows means some form of pressure on the individual funds, and this is what we're looking at. And also, I take from what Donald said, thank you very much for this very interesting comments on the use of swing pricing as a liquidity management tool, and the way of you described the slicing, the pro rata versus risk-adjusted pro rata, I think you called it. That is a very interesting point, and that's something that I will certainly take back to the organization. Thank you very much for that.
Thank you, Stefan. Bob, how are investors currently positioned, and are they prepared for potential market or liquidity pressure?
Before I talk about investor positioning at the moment, I think just two initial observations. If you look at central bank balance sheets, if you add up the total assets of the Federal Reserve, the ECB, the Bank of Japan, and the People's Bank of China, central bank assets are currently around 28 trillion US dollars. And if we look at the Federal Reserve, back at February last year, their balance sheet was just over 4 trillion US dollars. Their balance sheet now is 7.3 trillion US dollars. And you've seen a very similar expansion in the balance sheet of the ECB. And just in a few hours' time, we will get the press conference from the January meeting of the ECB. And I don't think there's going to be any change in their current quantitative easing policy nor in their pandemic emergency purchasing program. So we've seen this very major injection of liquidity into money markets and capital markets from the central banks. And if you look at most indicators of financial market liquidity, they are currently running at or near record highs. One subset of that, obviously, which is a big challenge for fixed income managers, is the near record volume that we have of global bonds worldwide with a negative yield. And even in those markets where we have positive nominal yields, real yields are negative. So, in the United States, for example, one's looking at 10-year US Treasury yields at just over 1%, but with current inflation, which is probably going to rise, running at about 1.5%. So negative real and nominal yields, I think, are a major challenge, which is not new, but certainly it's a function of this major injection of liquidity into capital markets. Now, coming on to investor positioning, there are some very good surveys of how retail and institutional investors are positioned in markets. And I think just two observations. First observation is that from really April onwards, we have seen a steady flow into what is called risk-on assets. And that flow really accelerated in November and December of last year. And the catalyst for that acceleration, obviously, was when we got more positive news on vaccinations to deal with the coronavirus. That has resulted, and Stefan commented on elevated valuations in his initial presentation. But we've now got a situation whereby, if you look at, for example, investment grade bonds, the market 5-year CDX for North American investment grade spreads is now less than 50 basis points. That is near a record low. High yield spreads for 5-year have come in at less than 350 basis points. So that we've seen really steadily throughout the last 6 to 9 months, this compression in yield spreads. Associated with that, obviously, has been the rise in equity markets and also in commodity markets. And it was actually, if you look back at 2020 as a whole, in equity markets, it was actually very interesting that we had this huge divergence in the performance of different sectors. So obviously, sectors which were less immune to the coronavirus outperformed, and that was notably in the tech sector. Sectors such as hospitality, transport, leisure, which were more vulnerable to the coronavirus, saw real underperformance in equity markets, and that's where we have seen increased delinquencies and defaults in the bond markets. I think just one observation I would make on defaults and delinquencies, I think, is that now there is clear evidence that in the first quarter of 2021, that default rates are in the process of peaking. And I think investors taking a position back into high yield markets on the expectation that we will see some trend decline in default rates. My own view is that that's probably a correct positioning. So we've seen this risk on position. I would just, there's a lot of discussion in the media at the moment about whether markets are forming a bubble and, whether we have a similar situation that we had at the end of 1999 with the tech bubble, and whether we've got a similar situation to 2007, 2008, when there was extreme leverage in markets and where valuations were very stretched. And my argument is that we do have evidence in certain areas of market bubbles. I would highlight one area where I really question whether investors understand the risks, and that is investing in special purpose acquisition vehicles, where a very significant number have been launched in the States over the last 6 to 9 months. Another area, which is a completely different subject, is Bitcoin, where we've seen this extraordinary rise in the price, and I think the Financial Conduct Authority and the Bank of England in the UK have been quite right to just to highlight the risks. So those are two areas of potential bubbles, and I would call those pockets of bubbles. But the overall trend, clearly, in terms of investor positioning, has been this reduction in cash levels, increased risk appetite in investment grade and high yield bonds, and in emerging debt, and in global equity markets. And associated with that, I mentioned earlier on the collapse in commodity prices in the first quarter of 2020. Obviously, recently we've seen commodity prices really across the whole universe start to rally. I think one area I mentioned earlier on, a number of areas which potentially have illiquidity problems, whether it be the loan market, whether it be certain areas of real estate, certain areas of infrastructure, where potentially I think liquidity, looking out over the next 2 to 3 years, could be a challenge. So at the moment we have pockets of problems. I think it's fairly clear where we as investors, and also whether it be organizations such as ESMA, need to focus. And I think it's less so on the corporate bond market, but more so on those areas which I have touched on in my earlier comments. So I'll pass on to Donald there to follow up, please.
Yes, thank you, Robert. So on your assessment of the current market conditions, which is bullish, yes, I absolutely agree. And on the question I've been asked to think about, which is what might cause a further redemption pressure in this year, it's about negative surprises, and sharp negative surprises that would damage that confidence. And this is really about investors making asset allocation changes at short notice and what might cause that. So, first up, clearly front of mind here is COVID. So I mentioned earlier, we could have more adverse news. The viruses mutate constantly. We can expect thousands of these mutations. Some may be worse than others. There's no sign of it yet, but it's always possible that the current set of vaccines will prove ineffective against one of these variants. That's always a risk. So that would be too stressing for us all personally and damaging in many ways. But from a market perspective, I am actually less worried about that. So much of Europe is already in various degrees of lockdown. Markets are functioning, not here in London, we're completely locked down. But the markets, you wouldn't notice that. So in terms of what would cause a sharp change of a sentiment, I don't think that's going to be it personally. The evidence from Asia, where social distancing rules are much more willingly adhered to, is that you can run an economy nearly at full capacity, even without vaccines. Now, it may be taking us longer in the West to realize this, and maybe we're not willing to change our personal behaviors. But if that were the outcome, I think we would all collectively change our behaviors. And so in terms of, could we operate like this for long periods of time? My feeling is actually we can. Yes, it would mean changes in the structure of the economy, and certain sectors of the economy would be negatively impacted, but others would benefit. And so this is a rebalancing in the face of a macroeconomic event. As long as it moves relatively smoothly, I don't think it would cause mass redemptions in any certain way. So, COVID aside, it brings us back to more traditional economic worries. There's always the political issues. Threat of trade tensions between the US and China is still there. Geopolitical instability has not gone away. We've got the Gulf, Iran, North Korea. These could all trigger a very rapid flight to safety. More traditionally in economic place, rising inflation with the current stimulus packages is a topic of discussion at the moment. But for me, on its own, that wouldn't necessarily trigger redemptions. It's the pace of any quantitative tightening that would accompany it that is the important factor. So currently the Fed's dot plots are flat, so effectively near zero rates, 20 basis points, until 2025. Now the market has started pricing that in from 2024 to the end of 2022. So the market is expecting a more aggressive movement from the Fed than they are saying they're going to do themselves, and curves are steepening in response to that. So this is the start of a market-driven quantitative tightening. So currently my top macro worry is the possibility of sharply rising real interest rates in the US. So that is Treasury yields in the market rising faster than increases in inflation. Now, I don't expect a repeat of the taper tantrum, which was a recent occurrence of that type of event. Central bankers have been much more careful in their language since then. However, the taper period, forget the events of April, May that year, The actual tapering process lasted about 2.5 years. Over that period, it was good for developed market equities because it was actually in the back of rising economic growth. It was okay for emerging market equities, and it was great for floating rate fixed income products. And if you've looked at the inflows into US levered loan funds recently, you'll see that is repeating because they are obviously protected from these rising interest rates. But historically, that's been a very bad environment for high yield and emerging markets. So, if the investor base who have a yield target, if they can achieve that in a safe asset like treasuries, then they will reallocate. And so a sharp increase in those real rates is something that, in the case of dedicated high yield and EM funds, not multi-sector funds, but funds that only invest in those asset classes, that's a risk of sharp redemptions that we have in mind at the moment.
Thank you, Donald. Stefan, based on the key findings we discussed earlier, what are ESMA's policy recommendations?
We have identified out of this deep dive into the real estate and corporate bond segments 5 priority areas for action, and they're all addressed to national supervisors and market participants, right? And also a few thoughts on future regulatory action. So I'm glad to hear that I think it was Stefan who made the point about exactly ensuring that the design of funds corresponds to the risks that they are taking. I'm glad to hear that this is also a concern of panel members. The first point that we make is that we need to get better at ensuring the alignment of the fund investment strategy with its liquidity profile and its redemption policy, right? That is at the core of the liquidity problem that many funds have had in the past months and years, and it's a structural one. I mean, it's built into the design of funds in general, and it shows in periods of stress, and we're calling on market participants and supervisors to have a very close look at this. Second, we greatly in favor of strengthening the liquidity risk assessment that is undertaken by investment funds on their portfolios, and in particular, the breadth of the factors that are taken into account, including, and I think Bob and Donald made the point about margin calls and the liquidity issues that these may pose on investment funds as they operate, but also loan covenants in real estate investment funds, and a number of other factors that should be operationally part of the risk assessment, of the liquidity risk assessment in the fund industry. And again, this goes out to market participants and local supervisors to actually have a very close eye on this one. The third point that we make is that the liquidity profiles that funds, in particular in the alternative world, are expected to provide need to be further specified in the regulatory environment, and need to, in particular, speak to the realistic and conservative estimates which percentages of the fund's portfolio, for example, can be liquidated. These are very detailed points that we have also provided in the report, but they should be tackled going forward. And the same applies to the availability and the use of liquidity management tools. I think this is a long-standing issue also by the industry, but also from our perspective in ESMA, but also in the ESRB, we have now for quite a while said that the availability of liquidity management tools should be more harmonized across the European Union and clarified such that investment funds can have equal recourse to these tools. And I think it was Donald who made that point earlier on, if I'm not mistaken. Some retail investors, like the people in the street, were not aware of, for example, the suspension tools. So it means also that people on the street can rely on a clear view of what the liquidity management tools actually are across the industries. And then finally, I emphasized in my risk part that valuation issues are something that we find a key concern of market participants themselves, but also on our side, that it is not necessarily the disappearance of liquidity as such. This is, of course, a very bad situation. But even before that, just the uncertainty about the valuation and the reliability of and availability of prices today and tomorrow is an issue, and that this issue needs to be better reflected in the risk management processes in companies. This is a point that we're making. Now, this is a readout from the Corona situation and very focused on the studies that we undertook with respect to real estate and corporate bond. But of course, this does not happen in isolation. This is a process that has been going on for a few years. And let me just briefly point out the many processes that we in the past years have actually set off in order to tackle liquidity problems. First of all, there is now a solid framework for liquidity stress testing in investment funds through the stress testing guidelines that we issued in 2019, and we just had in 2020 an update where we make clear that these stress tests need to be risk adequate, they need to be sufficient, and they need to be consequential. So they need to be embedded into the risk management process of the fund itself. Second, and I just went through it, the findings of the liquidity report and the recommendations that we made there. But let me also, on top of that, point out, first of all, that we, in 2020, we also provided guidelines on the issue of leverage in alternative investment funds. So there is now the completed framework for applying Article 25 in AFMD and the application of leverage limits in the European Union and amongst the national authorities. And then finally, we also issued in the middle of last year a letter to the European Commission in response to the AFMD review, where we sketch out our own priorities for the AFMD review itself, but where we also clearly say that this reflects also on the UCITS framework. We believe that a greater harmonization between the AIF and UCITS frameworks should be sought, and that in particular, we should have portfolio level data reporting requirements across the fund universe, like we have it now on money market funds, and a consistent availability of liquidity management tools. So this is clear that strengthening the liquidity resilience of the fund industry has been a key concern of ours in the past, and the Corona situation just confirmed us in our view that there is a lot that we all together need to do in that space. And with that, I hand it back to Irene.
Thank you, Stefan. Stefan, what could be done at policy level to further enhance fund liquidity?
First of all, I think that what Stefan mentioned is very meaningful in many ways, to be very frank. And overall, once again, that report was very good as an aggregated view with the limitations of aggregation of what happened in last year. But from a pure policy perspective, I have a series of comments on what Stefan mentioned. But beforehand, I'm wondering from a liquidity perspective and more risk perspective, I'm wondering, maybe I have a question to you, Stefan, before entering a response to Irene. Maybe I have a question to you, Stefan, regarding the Brexit. Because, as I said, it's critical to ensure a smooth exchange of information, including on market data, and especially in periods of crisis or tensions, among regulators, being either securities regulators or central banks. And I'm wondering that does the fact that the FCA is not a member of ESMA anymore, if I'm correct, for instance, and similarly for central banks, I mean, with the Bank of England out of the EU, has any consequence on the smooth exchange of information or not? It's a very sincere question, because I'm a bit concerned that from a pure geographical European perspective, including the UK, the Brexit may have some impact. I know that an MOU is going to be signed in the next few months between the European Commission and the UK authorities, but still, I'm wondering if, for instance, at ESMA's level, if there is still the same smooth quality of exchange of information with the FCA as before.
First of all, I think it is clear that with the situation around Brexit and the departure of the UK, the data that we used to have on UK markets have completely disappeared from our landscape. There is an exception, so to say, and that is EMIR and securities financing transactions data, where, of course, if a transaction has a leg in the UK or in any other third country for that purpose, we would still see that. But other than that, the evidence on UK market performance has disappeared from our radars. Yes. And second, like you rightly pointed out, Stefan, we're working on making an exchange of information possible on the basis of memoranda of understanding. And this is a process that is ongoing, and we are all hoping that, and you know, in line with what you said, it will be important to have a reasonable exchange of information at our levels, to be aware, given that the UK remains the largest single financial market on the outskirts of the European Union. So this is something we're working on. Yes, absolutely.
Okay, no, okay, thanks for that reassuring message, but I thought it was a very important, at least in my mind, point to be made and questioned. Okay, and sorry, Irene, answering your question on what is proposed by ESMA in terms of policy actions, what I fully support what Stefan and ESMA is proposing in this report, is at the level of supervision by national competent authorities, NCAs, definitely on fund design. Obviously, designing a fund is a primary responsibility of the fund managers. It's clear. But if we speak about regulated funds, national regulators have also a critical role to play when they give a license to the fund, and afterwards when monitoring on an ongoing basis what is happening. And once again, making better use of existing data is critical from that perspective. And existing reportings. And also, I support what ESMA or Stefan have said or written regarding liquidity risk assessment and valuation processes. For instance, for valuation processes, once again, regulators have to make sure that internally, fund managers, when they manage in particular regulated funds, among others, have appropriate tools and processes to ensure the best valuation on the basis of what is accessible as data from the market. And that's why maybe we have to better think, as I said earlier, on the way markets are functioning and market data are accessible for the overall industry to make evaluation the best as possible. Where I'm more concerned, to be frank, with you, Stefan, is about, you know, reflecting on revising, if I understand properly, some part of the current IFMD reporting. Typically, it is mentioned in the ESMA's report that we should get a better knowledge of the liability side of fund investors. It's a very good intent. But as we wrote it in an AMIC report twice during the few last years on fund liquidity, we currently lack information in many cases from our distributors or intermediaries regarding the ultimate profile of our investors. So it's a very good idea, but the issue is not in our side or in our camp. We should get the support from regulators to oblige distributors and intermediaries to give us the profiles of our end investors to get the best fine-tuned assessment of the liabilities on an ongoing basis. So, and we asked it already, and we are still waiting for the response of regulators. So it's not in our remit, unfortunately. But then, and more largely, I think we have to be careful on IFMD reporting, because as I said, we think that IFMD reporting is already very comprehensive. We are delivering it in a very smooth manner today to various regulators. But also don't forget, I mean, for the attendees, Stefan know it, that beyond our part of IFMD reporting, I mean, IFMD reporting is not at all the single piece where everything is in. We have already IFMD reporting with many information, which are very comprehensive on funds. But in addition, we have, for instance, the obligation to give fund inventories, which are by definition the most detailed information. We are currently giving fund inventories to some national central banks, e.g. the Banque de France or the Central Bank of Luxembourg, and AMIC, in the same report I mentioned, asked to get a better exchange of information of that fund inventories among central banks, but shared with securities regulators. This is typically a thing which is not done yet. Coming back to my previous point, to better exchange information among regulators and between securities regulators and central banks. And so to conclude, I would say on liquidity management tools, it's another point where I may diverge from what ESMA is proposing in what was presented by Stefan. From a risk-based perspective, and very frankly, once again, Stefan, from a risk-based perspective, the most important fund domiciles in EU 27, if we speak about EU as such today, are Germany, France, Luxembourg, and Ireland. The four of them have already now, because Germany included liquidity management tools last year in its own national regime, with Germany, France, Luxembourg, and Ireland, where now the four main fund domiciles in EU 27 have already liquidity management tools available. And very frankly, I don't see the need to launch, an unpredictable legislative action at pan-European level, at the level of the European Commission in IFMD review, on giving such tools beyond the four risk-based fund domiciles I mentioned, because no one knows across the overall legislative process how it will end ultimately. And we may face, at the end of the day, we may generate some systemic risk, by the way, if ultimately the legislative and regulatory process on IFMD review leads to a sort of straitjacket in making use of liquidity management tools. In case of crisis, it might, on the contrary, generate dysfunctioning in the practical use of liquidity management tools locally. So I think it's a very, very dangerous point, and I understand the sincere wish, but I also sincerely raise the concern, my concern, of generating a straitjacket which might not work and dysfunction in case of crisis. And I think it's safer to keep the existing liquidity management tools we have locally in the main fund domiciles I mentioned. Thank you.
Thank you, Stefan. Before I move on to the next question, Stefan, would you like to respond to any of those observations?
Those last two concerns, Stefan, the liquidity management tools, our concern that we try to convey is to make the availability, to harmonize the availability, to make sure that in all jurisdictions, also including the smaller ones, of course, that, for example, swing pricing becomes available as a liquidity management tool, that suspensions are available in any case. Side pockets, for example, of course, the exact design would then be, like you're saying, subject to an unpredictable legislative process. But just the availability would be a good thing, and we're thinking of making as many of them available as possible. I see your concern that, of course, legislative processes can be difficult, but generally speaking, I think, like you said, there is good intentions. That's one thing. On the AFMD reporting, there, let me also stress that, and we try to underline it in our communication, we're not thinking about a net new regulatory burden of portfolio data. That's not our aim. We are acutely aware that many of these data are already being collected in very diverse ways. In some member states, it is through the central bank, you mentioned it. In others, it's through the regulator. But across the European Union, these portfolio data are widely spread out across institutions. And the aim from our perspective should be, from a policy perspective, to bring these data together and make them centrally comparable, usable, and available. That might also be a difficult process, no doubt about this one, but let's be aware, not even the ECB at the moment has this access to these data that is being onboarded through national central banks. So they don't see these data. So this remains a purely national fragmented view of financial stability and systemic implications. And this is something where we say, like, okay, let's try and find a way of bringing it all together.
Bob, Andrew Houser from the Bank of England recently gave a speech discussing central banks needing new tools to deal with market dysfunction. What is your reaction to the idea of central banks becoming market makers?
I see you've given me the most difficult question at the last. First of all, central banks are already market makers in foreign exchange. The ECB is the lead market maker, for example, in the euro, and the Bank of Japan in the yen. Secondly, central banks are market makers in their own domestic money markets and government bond markets. So to some extent, this is already happening. Now, the question is, should they become market makers in other markets, and most notably corporate bond markets, and potentially equities? And just on the equity side, you already have some examples. For example, the Bank of Japan is the biggest owner of Japanese domestic equity exchange traded funds. Now, admittedly, they take, as do other central banks, more of a buy and hold strategy, but there is evidence already of central banks running quite significant corporate bond and equity portfolios. Now, I think the logic behind central banks becoming market makers in, for example, the corporate bond market and also the loan market is that we've seen obviously a major shift since the 2008 financial crisis in capital market activity away from the banks to our industry, the asset management industry. And that's why the regulators have spent a lot of time looking at potential or actual systemic risk in the asset management industry. So, the argument is that, if central banks, one of their roles is to be a lender of last resort to the banking sector, and as activity has shifted from the banking sector to the non-banking sector, there is a logic in central banks becoming market makers to support, for example, the corporate bond market. Now, I would make a very clear distinction to answer the question between central bank intervention and day-to-day market making. And I think there is a very strong case for day-to-day market making in the foreign exchange markets, in government bond markets. I think that there is only a case for intervention at times of market stress and where there is potentially systemic capital market failure in corporate bond markets. But the case for actually day-to-day market making by central banks in corporate bond markets, I really challenge that case. So I think intervention at times of stress, yes. Day-to-day market making, I think a lot of further research and detailed thought needs to go into that. But I hope that answers your question.
It does, thank you. And where do you see big changes in investor demand, and how does the asset management industry address that?
Well, I think a number of comments. The first comment just on the asset management industry is that a number of consultants have come up with reports recently saying how fragmented the asset management industry is compared with other industries, particularly comparing it with the insurance sector or with the banking sector. And therefore, there is a case for saying that we will see this year and potentially, over the next 3 to 5 years, further consolidation and concentration in the asset management industry, and much less fragmentation. So I think that's the first observation. And that, of course, is against a background where asset managers are facing revenue and cost pressures. So I think that profitability pressure will drive consolidation. Now, in terms of investor demand, we've discussed in this conference the fact that a number of valuations in asset classes now are looking somewhat stretched, but that obviously is a consequence of the current environment of negative nominal and real yields, which are pushing investor demand into less liquid areas. Now, on less liquid areas, I don't think in many cases we should be too concerned about that. If we look at the insurance sector and the pension fund sector, liabilities are very long term. And if I'm a pension fund manager, I'm actually not that concerned about liquidity because my liabilities might be 30 or 50 years. I want 30 and 50-year duration assets. And that's why I think we will see and have seen increased asset allocation into real assets, whether it be infrastructure or real estate, or to some extent private equity, by those long-term investors. So I think that trend very much will continue. We've touched on potential pockets of problems, which I think the investment management industry needs to be aware of. And now I come back to two examples of where we've had fund problems over the last 2 years, and that has been in the loan market and also in trade finance. And where there is leverage or concentrated risk positions in, for example, the loan market in portfolios, obviously there is the potential for problems from asset pricing, leverage, and liquidity. And I do think it comes down to the asset management industry. And admittedly, I'm biased, but I think the asset management industry over the years has done a very good job in risk management, and the number of accidents in the asset management industry actually have been very infrequent. And I think it comes down to those to conclude from my side: good liquidity management, good risk management, good management of leverage, and also I think very strong procedures and standards for asset valuation.
Thank you, Bob. We now have a few minutes left to address a few questions. Stefan, how do you think the COVID period issues compare to those experienced in the post-Brexit referendum period in the context of liquidity mismatches and open-ended real estate funds?
I mean, first of all, let me reiterate and highlight what I understand is a shared concern here around the table, that in the current market environment, there are overvaluations, and as far as this is measurable, there is quite some exuberance, not optimism, exuberance, borderlining exuberance from our perspective, and all of them again based on the assumption that policy support from governments, from central banks will continue. So I guess a lot of the thinking from our perspective in looking ahead is around the question of rate reversals or any other reasons why expectations in the market might change. I think Donald earlier on made that point that these expectations currently are a lot influenced by the corona situation, and any news flow around that situation, negative of course in particular, can change market sentiment quite profoundly. If we look at the average volatility measures that we have in the markets themselves, but also for fund flows, for example, they are still highly sensitive to news flow across the entire range of assets. And that is something I think to keep an eye on from our perspective. The post-Brexit world, of course, gives us new perspectives. We just had it in the discussion with Stefan. First of all, we need to get used to the fact that from an oversight perspective, we are now looking at a completely different landscape. I mean, just to give you an example, alternative investment funds. That directive 10 years back when it was designed was driven by the post-global financial crisis sentiment that hedge funds, someone needed to do something about hedge funds, right? And then out of that came the Alternative Investment Fund Managers Directive, where hedge funds until Brexit made up 5% of the total assets under management. And of those 5%, 80% were domiciled in the UK. It's not like these have now completely disappeared from our radar and our screen, because we have seen a number of new registrations of alternative investment vehicles building up in the European Union in the last 6 months. But it is a very good example of showing how immense that impact of Brexit actually is. And of course, it also means a change in the terms of liquidity of markets. And you're aware of the policy debates around the share trading obligation, the derivatives trading obligation, and so on. All of them have an impact on the thing. We are determined to look at these markets and evaluate the medium-term impact on markets from the withdrawal of the UK, on the structures of these markets, on liquidity levels in the markets, in the MiFID framework, for example. That is something we'll take a look on, and which will be very interesting to see, because it is at the moment very hard to predict.
Thank you, Stefan. And then last question for the whole group to consider. Why do so many mutual funds offer daily trading, despite evident differences in the liquidity of the underlying assets?
Once again, based on our AXA IM's case, at least, I think I should not set a general principle applicable to all, but at least in our case. And typically, coming back on the case of real estate funds, for instance, in our case, I mean, in all our real estate funds, we have a minimum period of 2 weeks for redemption. So we do not offer daily redemption on our real estate funds, as an example. But because it is designed depending on the type of strategy, type of asset, type of investor, and so on. So I think that this question on daily liquidity for funds, once again, must be approached from a pure micro perspective, depending on each fund, and not as a general rule. Except if you have a clearly defined setup, which is regulated as such, and typically, for instance, you have restrictions for, some flexibility in UCITS funds, because typically UCITS funds have a limited scope of assets, have a limited level of leverage, and so on. So the UCITS in a way is illustrating at a less micro level a type of fund design. But once again, this issue of daily liquidity must be followed from a pure fund profile perspective, on a case-by-case profile perspective, but within the scope of regulated funds, at least in our case. Obviously, once again, the critical point is also, I would say, the underlying possibility to trade on the underlying market. And it's probably where we have to improve things. Typically, I didn't have to mention it earlier, but on money market funds, typically, where we saw some tensions in March on the money market fund segment was on the dysfunctioning of some segments of the underlying market, typically on commercial papers. So once again, also the issue of daily redemption and daily liquidity might also benefit from a better functioning of the underlying markets, to be covered by regulators, by the way, improved by regulators.
Thank you, Stefan. I think this is all the time we have for today's webinar. A big thank you to all the panelists for your contributions, and thank you for dialing into our virtual event, and we hope to see you at the next one.